Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. For this episode, we're going to take a look at MiFID II, everyone's favorite topic to kick off 2018, but with more of a positive approach around that. And helping me do that at MarketSite this morning is Tom Conigliaro. He is the managing director over at IHS Markit. Thank you very much for joining us again.
Thank you.
Before we get into the positive aspects of MiFID II, let's talk about the challenge of the opt-out explosion, and what is that?
So the rules that have been put forward with respect to MiFID, specifically around research reporting and budgeting and the manner in which asset managers have to pay for research or fund research under MiFID, the rules are quite significant and quite draconian in many respects. And what we've seen is a number of managers, now the number is up to 70 major firms, who have said rather than following these MiFID rules around research funding, they've opted out by deciding to pay for research out of their own P&L. And by funding research themselves, they are opting out of the regs because they're not using client assets to fund research. They're using their own resources.
So they'd rather spend that kind of money versus going through the implementation struggles with MiFID. Is there any penalty to them, or?
No, there's no real penalty other than potentially a financial penalty, in that that's a significant burden that they're taking on themselves in terms of funding research out of their own P&L, instead of using client assets and the commissions that are generated, as has historically been done, to fund research. So the penalty is that they're self-imposed penalty, and that they're taking a financial penalty in reality. Right. And I think it speaks to how potentially troubling some of these rules are from their perspective, that they'd be willing to do that.
Well, let's look at it from a positive perspective. Clearly, with this major effort with MiFID II, a lot of innovation is going to come out of it.
Yes.
How do you approach that?
So clearly, necessity is the mother of all invention, and these rules are lighting a bit of a fire under some fundamental changes that have already been taking place in the industry. But clearly, with research budgets under pressure for those firms that are deciding to stay within MiFID and to fund research through more traditional means, they are still going to have to really nail down their budgets. They need to negotiate rates with their research providers. And the whole system is being challenged in a way, because some of the changes from these MiFID rules are dictating to participants things that they've never done before, that they have to do. So as a result, whenever there's economic pressure and changes in business models, in order to maintain some margins, you're seeing already some significant innovation, a few of which are, the explosion of machine learning and using alternative data and deep learning and all the things that we're seeing there. We're also starting to see, for example, certain research providers index their own research, looking to potentially hedge themselves against a day where they see maybe the business of selling research independently becomes so pressured that they may want to get into more of a passive strategy themselves. So we are seeing a lot of hedging going on right now with respect to business models, because everyone understands what the rules are and what the impact will be. What people don't understand just yet is how deep will those cuts go. I mean, are we cutting out some of the fat in the industry, or are we actually cutting into some meat and bone? And that's the big question mark right now.
And that's why we spent some time on managing MiFID II, between the application and the administration of it and doing the prep work for it. You actually had more items on the pro side of the pro and con list. Let's kick it off with some of the pros. And I think looking at accountability, for example, that's a big deal for the business.
It is. I think one of the challenges has been for the industry that this whole world of funding research has been very opaque, not only to outsiders, but to the underlying clients. And the whole purpose behind one of the core pillars of MiFID with respect to accountability was making asset managers more accountable to their customers in terms of the money that they're spending, in effect, on research. And the MiFID rules is really driving at the heart of that by making that whole process more transparent so that asset managers are more accountable. The challenge there, as I pointed out earlier, is that so many firms are opting out and funding research themselves, that potential benefit that regulators had expected may not come to fruition as a result of just the reaction of the markets.
Right, but you also had mentioned on the pro side, improved budgeting and valuation and so forth. Yep. With managers opting out, does that erase it at all? Does it kind of mitigate it?
It does to a degree, except when you're spending your own money on products and services as opposed to spending, quote unquote, someone else's money, the regulators have argued that they think the asset managers will become a little sharper with their pencil. So there is some benefit even to those asset managers that are opting out and deciding to pay for research themselves. They still are going to use as best practice some of these MiFID guidelines around research budgets and negotiating more proactively with their research providers so that they can save their own P&L some margin as well.
Right, and how about, let's wrap it up with price discovery and efficiency.
Yeah, so that's another potential problem in the current construct of research in general. In most cases, research is delivered to a customer with an expectation that you'll be paid for it through trading activity, but there hasn't historically been, especially away from the independent research side of the business, there hasn't historically been any real agreement on what that price is. So regulators find that that is somewhat alarming in that the price is never really agreed. And the MiFID rules, again, require that budgets be set from the asset manager's perspective, and you can't set a budget without knowing what your costs are, and you don't know what your costs are unless you're negotiating prices with your providers.
Right.
So that's another area of benefit that the marketplace expects to see.
With these managers opting out, and it sounds like a rapid pace more than I had expected, do you think regulators will go back and re-examine MiFID II and perhaps alter some of the regs? Is that on the table at all?
I think there are some folks that are hoping that that happens, and
It's
I think
still too early.
It's still too early. I mean, we're really just kicked off January 3rd. However, I would say that the velocity of these rule changes and the changes that we've seen as a result already, when we're a week into MiFID, is pretty significant and probably took the regulators a bit by surprise. So my guess, educated guess, is that they're going to keep a very close eye on what the unintended consequences are of these regs, and there always are unintended consequences. And perhaps there'll be a MiFID III, and I'll be the first to alert you when that happens. But I think there is a real chance that these rules could be revisited if the changes that have occurred are not ultimately beneficial for the industry.
All right. Well, thank you very much for joining us at MarketSite. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.